Hello and welcome. I've wanted to do this video for a while because it is something that I believe can greatly help a large majority of people who are starting off their journey of investing. And that is how to invest your first 1,000 Rand. The advice I'm about to share with you is the same advice that I recently shared with one of my friends when he asked me, how do you start investing?
And so for that reason, I'm out.
And if you do want to go ahead and invest, I always recommend consulting with your financial advisor beforehand. Lastly, at the end of this video, we will have a look at the power of compounding in the long term, which I find rather exciting. So let's get started. First thing, you would want to go ahead and put 1,000 Rand into a diversified ETF. Now, I know you might have heard this before or read about it somewhere or heard it from your friends, but there is a very important reason why. Actually, there are multiple reasons. The first one is that it is incredibly hard in the long term for your large fund managers to outperform the market. So, you know how the saying goes, if you can't beat them, join them. Please note the word large fund managers. Why is this? It's quite simply the law of diminishing returns. It is hard for large fund managers to outperform the market because they are limited in terms of the investment opportunities that they have available to them due to their size and the size of the funds they are managing. Take Berkshire Hathaway, Warren Buffett's investment vehicle. The company is so large that it can only really invest in the largest companies in the world in order to generate a decent return. And this puts large investment managers on the same playing field as your diversified ETFs. And ETFs do generally have lesser fees than actively managed funds, which is also a bonus. Secondly, you probably don't know much about financial analysis at both the qualitative and quantitative level to be investing aggressively into individual shares, because if that was the case, you wouldn't be watching this video. Let's go ahead and hear what Warren Buffett has to say.
Good morning. My name is Ted Friedman. I'm from Cincinnati, Ohio. You said in a 1996 annual report that most investors will find that the best way to own common stocks is in an index fund that charges minimal fees. Two questions. First, there are a lot of different index funds that hold different baskets of stocks. What criteria would you use or recommend to select an appropriate index fund? Second, the price to earnings ratio of the S&P 500 is significantly higher than its historical average. What benchmark should an investor use in purchasing this index?
Yeah, I would say that in terms of the index fund, I would just take a very broad index. I would take the S&P 500 as long as I wasn't putting all my money in at one time. If I were going to put money into a index fund in relatively equal amounts over a 20 or 30-year period, I would pick a fund, and I know Vanguard has very low costs. I'm sure there are a whole bunch of others that do. I just haven't looked at the field. But I would be very careful about the costs involved because all they're doing for you is buying that index. I think that the people who buy those index funds on average will get better results than the people that buy funds that have higher costs attached to them, because it's just a matter of math. If you have a very high percentage of funds being institutionally managed, and a great many institutions charge a lot of money for doing it and others charge a little, they're going to get very similar gross results but different net results. And I recommend to all of you reading John Bogle's written a couple of books in the last 5 years, and I can't give you the titles, but they're very good books, and anybody investing in funds should read those books before investing, or if you've already invested, you still should read the books, and it's all you need to know really about fund investing. So I would pick a broad index, but I wouldn't toss a chunk in at any one time. I would do it over a period of time, because the very nature of index funds is that you are saying, I think America's business is going to do well over, or reasonably well over, a long period of time, but I don't know enough to pick the winners, and I don't know enough to pick the winning times. There's nothing wrong with that. I don't know enough to pick the winning times. Occasionally I think I know enough to pick a winner, but not very often. And I certainly can't pick winners by going down through the whole list and saying this is a winner and this isn't, and so on. So the important thing to do, if you have an overall feeling that business is a reasonable place to have your money over a long period of time, is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time.
So there are two things that I would like to add here in order to perhaps clarify for some of you watching what Warren Buffett just said. So the first thing that Warren Buffett mentioned is that he wouldn't recommend going ahead and just putting a chunk in. Now, to just go ahead and add some context to this, if you are someone who's sitting with about 1,000 Rand, what he's saying is go ahead and put that 1,000 Rand into a diversified ETF. But what he's saying is that you only really get the benefit of something like a diversified ETF is when you go ahead and you add money over time to that investment. So I just wanted to clarify that for you guys. What he's saying is take your 1,000 Rand, put it into a diversified ETF, and then in addition to that, in order to really get the benefit of it as an investment vehicle, you need to go ahead and over time, whenever you receive your salary on a monthly basis, invest a portion of that back into the ETF. Now, I also want to comment on what Warren Buffett also mentioned over there, and that was the fees. Now, the bonus of investing in something like a non-active diversified ETF is that these ETFs have very low fees. To give you an example, I think the Vanguard S&P 500, the last time I checked, has a fee of about 0.05% or 0.03%. I may need to correct myself there. But that is extremely, extremely low. Now, when you look at your actively managed mutual funds, so this is where you have a fund and there's someone at the helm who's deciding which stocks they want to go ahead and invest in and is not guided by some broad market index, someone who's essentially a stock picker, their fees are normally much, much higher. You're looking at fees ranging from 0.5% all the way up to 1% and even more than that. So that is another benefit of the diversified index ETFs, which Warren Buffett just mentioned, and that is that they have very, very, very low fees. And obviously, the lower the fee, the more money you have for yourself. So let's go ahead and continue listening to what he has to say.
As to the criteria as to when you should or shouldn't, I don't think there are any great criteria on that. I don't think price earnings ratio, determines things. I don't think price book ratios, price sales ratios. I don't think there's no single metric I can give you or that anyone else can give you, in my view, that will tell you this is a great time to buy stocks or not to buy stocks or anything of the sort. It just isn't that easy. That's why you go to an index fund, and that's why you buy over a period of time. It isn't that easy. You can't get it by reading a magazine. You can't get it by watching television. You'd love to have something that said, if PEs are 12 or below or some number you buy, and if they're 25 or above you sell. It doesn't work that way. It's a more complex business than that. It couldn't be that easy when you think about it. So if you are buying an index fund, you are protecting yourself against the fact that you don't know the answers to those questions, but that you think you can do well over time without knowing the answers to those questions, as long as you consciously recognize that fact. And I would, if you're a young person and you intend to save a portion of your income over time, I just say pick out a very broad index, and I would probably use the S&P 500, because I think if you start getting beyond that, you starting to think you should be in small caps this time and large caps that time, or this foreign side. And as soon as you do that, you're in a game you don't know. You're not equipped to play. In all candor, that would be my recommendation.
So, very interesting what Warren Buffett just went ahead and said. And it also kind of does relate to the previous video which I brought out, which relates to when is the best time to buy and sell your shares, which I will link here. But to add to what Warren Buffett has just said, and something I myself have spent a significant amount of time trying to figure out, when is the best time to sell if you were to go ahead and look at common metrics such as your PE ratio, which is widely watched by many people around the world in order to determine when is a good time to enter the market. And the problem with all of these ratios is that if you just go ahead and look at the research, just because a PE ratio is at an all-time low does not determine that the market is in itself undervalued. You see, there are many factors which influence it, such as the interest rates. The interest rates have a large impact on the PE ratio of the market. And essentially, all Warren Buffett is saying over here is that there are just so many factors which can influence the market and its movement in the short term that trying to pick the exact moment when to go ahead and invest is essentially a waste of time. Now, I do recommend for all of you who have 1,000 Rand sitting by and you'd like to go ahead and start investing, that based on what Warren Buffett just said, the best time to go ahead and invest is now. So this brings me to my next point, and that is that while you have your money sitting in a diversified ETF, you can go ahead and start to learn about investing into individual companies. Now, I learned the hard way. I wish I had this advice, because when I first started investing around the age of 14 or so, I thought I knew a thing or two about individual shares and how to find a good company. I'd covered a tremendous amount of literature at the time, and I thought I was well prepared. Well, that was not the case. From the age of 14 to 18, my stock portfolio went down about 30%. If I had the hindsight, I would have invested in a diversified ETF and used that time to manage a theoretical or a dummy portfolio. So one where you're not investing real money. That way you can learn from your mistakes without actually losing money. It may sound ridiculous, but I believe you need at least a year of theoretically managing a portfolio before you actually go ahead and do it. I know in my case, if I did this, I would have made more money. Lastly, and importantly, I only recommend one even ponders investing into individual shares if he or she is willing to put in a significant amount of time and discipline, both emotionally and intellectually. It is because of this that I recommend most people just invest into a diversified ETF and just call it a day. So, drumroll, what would have happened if you invested 1,000 Rand into the S&P 500 roughly 60 years ago? What do you think it would have turned into? Maybe 30,000 Rand, so 30 times your cash, or 50,000 Rand, so 50 times your cash. Let's maybe be even optimistic, something like 100,000 Rand. No, it would have turned into 500,000 Rand. Yes, you heard me right. If you put 1,000 Rand into the S&P 500 roughly 60 years ago, it would have turned into 500,000 Rand. And that is assuming that you reinvest all your dividends. That is the power of compounding, and now you know why Albert Einstein coined it the eighth wonder of the world. I hope you all enjoyed this video. See you in the next one.